Hi, everyone. It's great to have Jay Pelosky with us once again after a 3 week break. And we have a lot to talk about today. It's been a challenging environment, 2022, to say the least. And there's a story that Jay always tells us about, when he started his career. And he actually started in Brazil, when he had to launch a fund, a Brazil fund for Morgan Stanley. He's going to tell us, he's going to start by telling us the story of how that compares, how what we saw at that time compares what we're seeing today. So welcome again, Jay, and over to you.
Thanks, Roberto, and great to be with you again. And yes, that's one of my favorite stories, and it goes back to 1990, and it was my first job at Morgan Stanley. I had been working for a couple of years, but had just joined Morgan Stanley Asset Management. And Barton Biggs, who was running asset management at the time, asked me to go down to Brazil and lead a Brazil fund. And so it was Morgan Stanley Asset Management and the IFC, an arm of the World Bank, which was helping kind of develop these emerging market country funds. And the two of us couldn't raise any money. Now, of course, this was during the hyperinflationary period in Brazil, which some of the folks on the call may remember, or certainly have seen and heard stories about. But it was a very difficult environment. And so we were almost unable to raise any money at all. And then a hedge fund buddy of Barton's came in and allocated enough money for us to get to 25 million or something. And we were able to launch the fund. But it was a great lesson because it showed the difference between the time to market and the time to invest. Because if you go back and look at a dollar-based chart of the Bovespa, you'll see that 1990-91 was pretty much the absolute dollar low. So it was absolutely the time to invest, but it was clearly not the time to market. And I think we're in a similar situation today in a number of fronts within the markets where, if you look at the IPO market, there was just a big headline in the FT this morning, right? Where Europe and US IPO proceeds are down 90% year over year. 90%. So it's clearly not the time to market. But arguably, I think it's getting close to the time to invest. And I think we should be focusing more on the investing side than on the marketing side or on the selling side.
Yeah, no, and it's great. So, and there's a lot of, bad news in the price. And I think one of the quotes from Barton that you mentioned in the monthly is that he says that the bad news are always in the price, and those were different times, when we do not have Twitter and all of the social media, and you get the news from a very limited number of sources, but of course they would find their way to the market very quickly, and I took note of a few and use a similar methodology because we say that what's plaguing the market today is a toxic cocktail. But looking at 4 or 5 areas where possible good news could come from, I would list of course ceasefire in Ukraine, an aggressive policy action in China, commodity prices stabilizing or hopefully coming down. And finally, a cooling off of the U.S. Housing or labor market. So can we go through these four, or some of them, and maybe you could tell us where have we already seen some good news, and where could we possibly see good news in the future?
Yeah, no, that was a good part of the monthly. And it came from a conversation with a very experienced guy who's very senior at one of the big banks in the US. And we were in the executive dining room having lunch. It's the first time we had lunch there in 2 years. And, we talked about how the markets, everybody was so negative, and he's a banker. So he was talking about the IPO market. And we hit on the idea, well, what about good news, right? I mean, how much good news is in the price? And so I listed a number of the things that you just touched on. And I think, well, clearly, the Ukraine ceasefire is not in the price, and it looks like I've been of the view that time is not Putin's friend, and it was not going to be a long conflict. And we've now marked 100 days, which isn't really long in terms of conflict, but is a good chunk of time. And what I draw from that is the idea that Europe has decided finally to embargo Russian oil. And yet the Brent crude is, 118, 119, 120. Remember back in March, the beginning of March, when these ideas were first kind of kicked around, Brent was at 135. So the thing that we were afraid of 3 months ago and it led to a Brent at 135 today is actually happening. And yet Brent is at 120. And so we've had time.
That's a great point.
Yeah, well, we've had time to kind of think about it, right? Markets don't like surprises. Once the market has thought about it, digested it, priced it in, okay, it's no longer a big issue. And so I think that's an important thing to watch how the market responds. And to me, that's a really good sign that Europe has been able to kind of rejigger its energy supply, right? That's an important point. And B, markets have had time to digest the idea of an oil embargo. And so C, here we are with the oil embargo now starting to unfold, and yet Brent is very well behaved. So I think that's an important kind of example of how the news flow, my musing. So we went from the monthly, which was titled The Time to Market and The Time to Invest. And then last Friday's musings was the news doesn't have to get better, just less bad. And I think that again is a Barton comment. I didn't steal, but I've adopted a lot of Barton's comments because he was obviously a great strategist and a great investor. So that's one. The China policy, again, we just saw it today, right? DD, they're talking about easing the regulatory issues around DD, and that stock was up 38%. KWeb, which we have in our global multi-asset model, was up 5%. It bottomed back in early March. It's up about 45% or so from the low, 35, 40%. Much, much better than NASDAQ. So the China policy mix is getting better. The lockdowns have clearly have ended, at least for the near term. And I think you look at Shanghai port activity, that's getting back towards normal. And so that leads you into the supply chain, which was another example of a positive surprise. And clearly, supply chain pressures are easing. You saw that with the ISM data in the U.S. last week. So that's good. And then we have the energy pricing and food pricing. And, couple weeks ago, we were just inundated with stories about how we're going to have famine and food issues and all the rest of it. And here today, lo and behold, wheat prices are down 30, 40%. Fertilizer prices are down 30 to 40%. And so with these commodities, they spike and they collapse. I mean, they go up on a spike and then they come right back down. So you've got to be very careful in how you approach that. But I think, again, the system is able to adjust over time. And lo and behold, wheat supply is found somewhere else. And there's a workaround in terms of shipping. And yes, prices are higher, but it's not that spike. And so that leads into inflation and recession. And clearly, in cooling off of inflation, to me, is really the critical point, because if inflation cools as we expect it to, then that takes the pressure off the Fed to act aggressively. And an aggressive Fed is what really brings the risk of recession into play. And if the Fed doesn't have to be aggressive because inflation is cooling off, then we probably have, we're probably in a bottoming process for U.S. and global equities, because this is a 20% type decline is what you typically get in a cyclical bear market without a recession. The recession bear market tends to be 35% or so and lasts for a good year and a half, give or take. And the difference between cyclical bear without recession and recession bear is simply the cut in earnings expectations that comes with the recession. So if we don't go into recession, the earnings don't have to get cut, and therefore a 20% pullback, a valuation derating, which is what we've had, is pretty much that's the extent of the damage. And so that's what that's how I see the whole thing playing out tactically, is that cooling off inflation reduces Fed risk, which reduces the risk of recession. Then that gives you a tactical opportunity, like a 3 to 6 to 9 month opportunity in the markets. But it also opens the door to the strategic opportunity, which is a multi-year opportunity driven by what we called in the monthly the new world of high nominal growth. So people were trying to talk about the new normal post-COVID, or going back to the pre-COVID levels of economic activity. And if you look at the future expectations for growth and inflation in 23, 24, 25, you see that markets are basically just penciling in the pre-COVID levels. And I think that's wrong. I think that we're not going to come back to 2% inflation. It's going to be more between 2 and 3. We're not going to go back to 2% growth or 1% growth in Europe. It's going to be 2 to 3% growth. And so we're going to have a nominal growth environment that's closer to 6 to 7% in the US, 4 to 6% in Europe, 2 to 4% in Japan. And it's much higher than what was pre-COVID. And this obviously then impacts earnings expectations and presents the opportunity for multi-year kind of earnings surprises. It also suggests that long duration rates are going to gradually drift higher as we move through 2022 and 2023, because we're going to have high nominal growth. So rates at the long end are going to have to stay elevated. They're not going to go back to 5%, but a 10-year at 3.5% or so in a year from now is probably going to be something that we should expect to see happen if we don't have recession, and that non-recession opens the door to that strategic multi-year growth path that we think is the new world. And that, as a quick reminder, is going to be driven by global CapEx, a CapEx cycle that we haven't had in the US since the mid-90s. And that's going to be driven by both government spending. You think of the fiscal spending in Europe for energy security, for defense, et cetera. You think about the 3 C's, right? We've identified the 3 C's: COVID, climate, and conflict. Those 3 C's need to be funded, and CapEx needs to be built. Reshoring, friendshoring, shrinking the supply chains, developing the regional integration that we call the tripolar world. That's all on the table in the next couple of years. And that's why averting a recession in 2022 is both a tactical opportunity and a strategic opportunity.
Yeah, no, this is great. And the final point where we could see potentially good news is, I mean, how do you see the cooling or eventually cooling off of the U.S. labor and housing markets? Because that's where I think we're gonna get the data and the Fed too, that will determine if the Fed is going to further hike or where they could potentially make a mistake. So how are you seeing these data?
Well, I mean, the jobs report on Friday was pretty clear cut, right? I mean, yes, it was better than expected, but it's also very clear if you look at like a 3-month average to kind of get out of the, the month over month kind of volatility. A 3-month average shows that job creation is definitely decelerating. It's still significantly above the pre-COVID levels of about 150,000 new jobs per month, right? We were at 390 in May. So still well above it, but down from the 500,000 to 600,000 new jobs we were creating towards the end of last year. So job creation is decelerating. The Fed is going to look kindly on that, because it then suggests that the wage pressures are also going to decelerate. And there too, you had good news in the average hourly earnings, the AHE data, which again suggested that wage growth has peaked and is starting to moderate. And you're probably going to have more of that as companies kind of readjust. And again, it's tricky because we're going from the goods demand of everybody being locked down in their house to the service demand. You and I were talking before we went live on my trip down to Florida, and canceled flights and full planes and all the rest of it, because everybody wants to travel, everybody wants to go out to eat. New York City foot traffic, hotel occupancy, all these things are back to 85 to 90% of pre-COVID levels. Tourism back to close to the pre-COVID levels here in New York City. And so that process is unfolding. And to me, I would expect a continuation of these trends. I think we've clearly peaked in terms of inflation. We may not get the step down that I was hoping for, I and others, in part because gasoline prices in the U.S. have continued to rise. But even here, we're seeing demand destruction. Demand for gas has been softening over the last couple of weeks as these prices really start to bite. And on the other hand, as an investor, this is driving the electric vehicle revolution, right? And we wrote about this extensively in the monthly. The EV revolution is getting turbocharged by $5 gasoline. So that is maybe a little bit of a hindrance in terms of the step down in inflation that we're hoping to see. But I continue to feel pretty confident that wage pressures are easing. Supply chains, which we touched on, definitely opening up much more, both in the U.S. and in Asia and in Europe. Housing, you mentioned, clearly rolling over. Mortgage applications, I noted in the monthly, are down 25% over the last couple of months. And while we still have a great under inventory of housing in the United States, the 5% mortgage rates are going to be challenging and cool off the housing market, which, because of that undersupply of houses, house prices have risen dramatically, 20% or so over the last year or so. So in essence, I think all of this stuff is moving in the right direction. And as an illustration, I mean, you just look at today. Rates backed up. People, the bond market sold off aggressively. The ag was down 60 bips, which is a big move for the Barclays ag today. And yet NASDAQ was up. Now, if we had a 60 basis, I bet if we went back and looked over the last, 3 months, on any day the ag was down 60 bips or more, I bet we would see a NASDAQ sell off of between 2 and 3%. Today, the NASDAQ was up. Why? Because everybody who wanted to sell on the fears of these issues has already sold.
Yeah. No, yeah. This is a great point, and it shows that the sellers have been cleared, and markets have adjusted to the new normal of higher rates. So we were talking about before, and you also mentioned this in the last session, that the market has already priced peak inflation. It doesn't look like for inflation not to have peaked, we would have to see oil at 140 whatever, and some of these other things, and that's clearly not happening. But the call now is on recession. So to what extent do you think the market has already priced recession? You mentioned some data points in the sessions before, and how much of that do you think is reflected on earnings?
Well, I mean, this is a great question, and a key question, right? Because we're trying to kind of tread that narrow path between high inflation on one hand and recession on the other. And our view at TPW Advisory is that we're going to go the middle path, right? Inflation is coming down. Growth, while slowing, does not mean slow growth, which we've been saying for months and months and months. Slowing growth, yes, because we had artificially high growth in 2021, but not slow growth and not recession. And that continues to be our view. And you look at the PMI data, really around the world, not suggesting recession at all. People keep talking about PMIs heading towards 50 and below, but every month and month and month goes by, and they're not going there. Europe's PMIs were pretty robust, and it's interesting, right? I mean, I saw this data point over the weekend that Europe's PMI, the composite, I think was 54.5 or 6, something like that. But here's the point, Roberto. Pre-COVID, that composite was 48. It was under 50 pre-COVID, before COVID even happened, in the fourth quarter of 2019. So where we are today is way above where we were pre-COVID. And yet, that doesn't seem to resonate with people, because the prevailing
That's a great point.
narrative
I hadn't taken note of that.
The prevailing narrative is, recession and war and high energy prices. And people forget that today's economy is much less energy dependent than it was in the 70s and 80s. We have a much different, much less energy intensive economic profile globally, and certainly in the developed economies, than we did at the time. The other data point that really struck with me, and again, it was a buddy of mine, long-time investor, very sophisticated, very sharp, pointed out to me that typically when the U.S. is going into recession, you have a number of states already in recession, right? Their own data is already weakening, because remember, we've got 50 states, and there are half a dozen of them maybe agriculture, or some of them are energy focused, what have you. And typically 45 are fine, but 5 or so are in recession, then 10 are in recession, et cetera, et cetera. Today, not a single state. Every single state is growing, and most states have lots of money. Taxes are coming in, tax receipts way better than expected. So governments have money, state and local governments. New York City has a budget surplus like it hasn't seen in decades. Same with New York State. Same with California. So corporates have tons of money. $2 trillion or so on their balance sheets, right? Buybacks are continuing to support the market, and will continue to support the market. Insider buying is likewise above selling. That's always a good sign, where corporate insiders want to buy their stock. And so then you look at the consumer, and the consumer, record low unemployment, $2 trillion or so of excess savings post-COVID. And yes, savings rates are being worked down, and credit demand is going up, credit card receivables, et cetera, going up. But there's no sign of, people being in trouble and not being able to pay their credit card receivables and things of that nature. And so you look at the three pillars, government, corporates, and consumer, they're all relatively fine. So, that's why I go back to the inflation picture in the Fed, because absent the Fed tightening too aggressively and crashing things, there's no reason to expect a recession. And I continue to think that's the case. And remember, we're shifting from goods demand to service demand. And remember that the developed economies are 75% consumer, consumption, and service. Yeah. Manufacturing in the United States is 15% of GDP. Not 50, not 60, 15. So I think that the fact that we're shifting to the service side and the robustness of the demand profile continues to suggest that a recession in the near term, 6 months, 12 months, is highly unlikely. Now, some folks say, we expect a recession in 2023, or we expect a recession in 2024. I guess certainly possible. Right? I mean, I don't know what's going to happen in 2 years. I mean, after the last couple of years, knows. Does anybody want to really say that they know for sure what's going to happen in 2024? I mean, I think that's kind of a joke. And I don't pay any attention to it. I'm focused on the next 6 to 12 months. and over the next 6 to 12 months, I think the likelihood of a recession, absent the Fed tightening too aggressively, which is reduced by inflation rolling over, I don't think there's any likelihood of recession. And then therefore you don't have that cut to earnings, which gives you that second leg down in the bear market with recession, as we talked about earlier. And earnings revisions continue to be positive. Earnings expectations continue to be on a gradual uptrend in the developed economies. So, you know, analysts who talk to companies just went through the whole round with Q1. We're going to go through it again in a month, right, for Q2, right? We're going to end up Q2 here in a month, and a month from now we'll be talking about Q2 earnings. And yes, there are the high-profile, you know, warnings like Microsoft last week, right, or Walmart and Target a couple weeks before that, but they weren't demand-driven, you know, earnings reductions. They were inventory in the case of Walmart and Target, and dollar, you know, FX related in the case of Microsoft. So demand is still strong, and if demand is strong, earnings will be okay. And then the last point on this is, again, the nominal factor, right? U.S. economy is growing at a nominal rate of between 6 and 8%. In Q1, year over year, nominal growth was over 10%. So earnings are measured in nominal dollars.
Yeah.
And therefore, folks who keep expecting earnings to be very disappointing are not grasping the fact that we're in a new world. And that's why we're making this point so aggressively at TPW Advisory, because we believe this high nominal growth rate world is going to be the new world. And it's going to be driven by those, you know, dealing with the 3 C's and the fact that governments and corporates and consumers all have money and have need to spend that money to deal with COVID, climate, and conflict. So high nominal growth suggests that earnings are not going to be an issue. And we've already had the valuation derating, particularly outside of the United States and within the United States. Big chunks of the market have derated pretty aggressively. On the other hand, parts of the market, particularly the defensive segments of the market where everybody has flocked to because of fears of recession, those are now expensive. And I've mentioned, I believe, on the live sessions before, that Alibaba, a month or 2 months ago, one of the top tech companies in the world, was trading at the same price to sales as Campbell's Soup, a soup company. And that's because everyone has flooded into the staples and into the defensive sectors. And those are the areas where I think one is at risk. Because if you do have a recession, let's just think about it for a minute. Everybody's now flooded out of the high growth stuff. They're out of the innovation stuff. They're out of, you know, lots of that space. They're flooded into the staples and defensive sectors and utilities. So what's going to happen next? If we have a recession, people are going to flee the market, and they're going to sell defensives as well as utilities, as well as other things. So those stocks go down. If there's not a recession, people are going to sell stocks so they can buy stuff that has already been sold, the growth names, the cyclical names, things of that nature. So in either case, the defensive segments are not attractive. And yet that's where the money is. When you see a world-class tech company selling for the same multiple as a soup company, then I think you really got to think for a minute or two, does that relationship make sense? And which side of that relationship do you want to be on?
Exactly. No, it's a very asymmetrical trade. I totally agree. And, you know, it finally looks like, you know, given that you mentioned Alibaba, that things, I think they did bottom in China, right? They were, you know, the statements and you mentioned, you know, Didi, you know, being up so much today. It really looks like, you know, the past is clear behind us, right?
Well, I think so. And, you know, we have been quite bullish on China coming into this year. We talked about China 2022 being a glide path year to deal with the President Xi expecting his third term in the fall. And obviously, it has not been a glide path year. And we had, we didn't expect the Russia-Ukraine situation. We did recognize the downside risk of zero COVID, but it's come back and kind of been more aggressive, certainly, than we had thought. So you may recall, I think 2 months ago now, we reduced our position somewhat to kind of hedge that because we were quite overweight. But we've maintained a small overweight in equities. We've maintained our fixed income positions, both dollar and local currency, and China debt. So we have a pretty healthy all-in position in China. So watching it carefully. And yes, I'm of the view that KWEB, if you look at the tech sector, it bottomed back in early March. And as I said earlier, I think it's up 30 or 35%. It was up 5% today. I've been disappointed in kind of the aggressiveness of the policy action in China. A lot of verbiage, but not a lot of action, right? Mm-hmm. And there's also been, interestingly enough, and I wrote about this and spoke about it in the politics part of the monthly, that there is, for the first time in quite some time, open dissent and rumblings between President Xi and his focus on zero COVID and other parts of the China elite saying we need to focus on growth.
Prime Minister,
Yes, need to focus on growth. And so that, I think that tension there actually has inhibited the aggressiveness of the policy response, right? You see what I mean? Mm-hmm. I mean, there's infighting at the top. And since it's a hierarchical society, you can't nobody's going to do anything until they get told to do it from the top, and the top is fighting. And so the policy action has been subpar, I believe. Now, nonetheless, it's a perfect example, and I use it in the musings of the news doesn't have to get better, just less bad. And I think in the case of China, it has gotten less bad, right? Lockdowns are easing. Policy seems to be getting better in terms of how they're dealing with the tech sector. The currency seems to have been stabilized after a little bit of volatility. The PMIs were better than expected, still below 50, but better than expected in May, up on April, and will likely to be above 50 come June. And you can see it. One of the things I like to track, because we have our reopening trade with jets, is the airline activity in China. And it bottomed about 3 or 4 weeks ago. One of the firms does a really nice job tracking departures and breaking it down regionally: Europe, Asia, Americas, and then China as well, because it's such a big market. And clearly, China's airline departures have started to pick up. So that suggests to me that internal travel is starting to reopen, and activity levels are starting to reopen. I think I mentioned the Shanghai port situation clearly has improved over the last couple of weeks. And so I think that China has bottomed on an equity basis, and we continue to be invested there, both in the A shares as well as KWEB, and then in the fixed income side as well.
Yeah, no, this is great, and using your usual methodology, the 5 pillars. Can we start with climate, the things that you mentioned on the monthly, and where you saw some interesting data points, and then moving on to of course, excluding the stuff you already said, but then moving on to economics, politics, policy, and markets. What we're seeing, new there.
Yes, that is our what we call our global risk nexus, right? Where we look at those factors, and that our top-down view, which we've touched on, is the tripolar world framework, and then the level below that is the global risk nexus, where we go through these big segments. Because as we've talked about before, but as a reminder, certainly in these volatile markets, and certainly doing global multi-asset macro investing, one needs to have a process, right? One needs to have a framework to work through. Otherwise, you're going to get swung all around, particularly when markets are as volatile as they have been the last couple months. And so for us, we start with climate because we believe that's the single biggest global macro theme, right? Every country in the world is going to be spending money on climate in a very defined time period of 2020 to 2030. We think it's the single biggest theme out there. And so we pay an awful lot of attention to it. And interestingly enough, when we went through our model portfolio update last week, let's remember, first we do the monthly, then the next week is the model update, and then we do the musings and so on. So when we did our model update, it was very interesting to see that in the thematic model we have, the climate space has really been the outperformer. And in particular, the electric vehicle space and LIT, which is the ETF we use to play this theme, really was the single best performing ETF last month. And the EV revolution in our mind is clearly here. And I note in the monthly that for the first time ever, a majority of global new car buyers want to buy an electric vehicle, 52%. And in the US, very interestingly, in the first quarter, new car registrations in the US, electric vehicle new car registrations were up 60% year over year. 60%. And that's with an overall new registration down close to 20% because of the shortages for parts, et cetera, et cetera. And again, Tesla, everybody loves to pound on Tesla, and just like they pound on Kathy Woods at ARC, but Tesla dominates the electric vehicle space in the United States. I think they had 100,000 cars sold in Q1. The next biggest was Ford at like 6,000. So 100,000 versus 6,000. Now, obviously, someone will come back and say, well, they're valued very differently, and they are, but I just think it's worth pointing out that the EV revolution is here. Majority of buyers want to buy electric vehicles. $5 gas definitely helps with that desire to buy an electric vehicle. And Tesla is the dominant player in that space. So that was really the thing that really jumped out on the climate side for sure, both from a portfolio perspective as well as just for the electric vehicle, really starting to become a real issue. It's now new electric vehicles, I think, are now 5 or 6% of the total U.S. car fleet, and moving up pretty significantly, both in the U.S. and in Europe.
Yeah, that's great. And on economics, we talked a lot about the recession and the non-recession already. So going into politics, you had a few interesting thoughts on globalization, and a lot of people talk about deglobalization, or maybe globalization at a different speed or at a different level. So what are your thoughts there, on the politics and what it means, for investing?
No, I think that's absolutely right. And again, one of the points I would say is that, at TPW Advisory, we've been thinking about globalization for over a decade, right? I wrote my first piece on the tripolar world back in 2010, 2011. So now 10, 11, 12 years ago. And everything we're seeing is playing right into the idea of regional integration in Europe, Asia, and the Americas is really the way forward. And the way we look at it, and one of the reasons why we're so constructive on a strategic basis towards Europe, is because we think Europe is increasing its integration and is moving faster as a result of what's happened in the Ukraine, moving faster with energy integration, moving faster with defense integration, moving faster with economic integration, and really becoming a robust power. And Europe is starting to realize what happens when it punches with its full weight, right? As individual countries, their countries are not that big or all that critical, right? Germany's 60 million people. France is, similar number, Italy, etc. But when you gross up Europe to the European Union, then you've got close to 600 million people, 18 trillion dollar economy, one of the leading trading organizations in the EU, a real force on the, leading regulatory charge on technology, likely to lead the regulatory charge on climate, biggest carbon emissions trading system by far in the world. And so Europe is recognizing through, in part because of what's happened in the Ukraine, the need and the power to punch as a union and not individual countries. And so that's something that continues to really resonate with us. And when we look at the policy mix, maybe shifting a little bit from politics to policy, when we look at the policy mix, Europe's policy mix is by far the more attractive one from an investment perspective. It has loose fiscal, right? The next gen spending program is just now hitting its stride, going to continue to support growth through 23 and 24. U.S. is tightening fiscal policy. The budget deficit here is going to more than halve this year. China has been pretty reticent on the fiscal side as well. And you look at monetary policy, clearly the Fed is in, tightening mode. If you look at the ECB, yes, the ECB is probably going to gradually tighten, but it's not going to be as aggressive as the Fed. And in Asia, you have the BOJ clearly not tightening monetarily. You have the PBOC likewise, but their fiscal policy is not as robust as it is in Europe. And so we look at the fiscal mix, the monetary mix. We look at some of the focus on joint financing and the potential for what that means for a true European safe asset and what that in turn will mean for the euro. As all that is being constructive. And so when we look at the political space where we see Europe acting very well in a crisis, right? Europe always tends to do okay in a crisis. It's the day-to-day where they seem to maybe drag their feet a little bit. But Europe is in crisis, and Europe is acting. And the oil embargo is the latest illustration. Again, contrast that to the United States. We have just an absolutely horrible gun violence situation happening in the United States. Absolutely horrible. The numbers, if you break down the numbers,
they're shocking.
It's incredible. It's so depressing. And yet we cannot seem to get any action through our political system. So people love to point the finger at Europe and say, look at how slow and slow moving and they don't get things done. But I mean, I don't know.
That's a great point.
I'm an American, but you look at the inability of the U.S. political system to move forward on the most basic of things. The most basic of things. We have military-style hardware available to 18-year-olds. Boom, off the street, pick it up, go out and shoot somebody. It's ridiculous, and yet I don't think anything is going to change. Look at Biden's Build Back Better program, right? It's the opportunity for the U.S. to really get in the climate fight. Not happening. Unlikely to happen. We're going to have the midterms. What's going to happen? I mean, it's depressing. So I didn't mean to get off on a tangent there, but the bottom line is I think the policy and political mix in Europe is the most robust in the three regions. Asia, clearly President Xi not moving on zero COVID, disagreements at the top between zero COVID versus growth. So their political mix is, under some pressure. And we just talked about the United States and the Americas. We are having the summit for the Americas right now. Tremendous opportunity for North and South Central America to come together and build kind of a hemispheric approach to climate, leveraging all the natural resources that exist in South and Central America and developing a hemispheric cooperation. Do I think that's going to happen? Sadly, no, I don't think it's going to happen. And so, we have the U.S. reaching out to Asia through the Indo-Pacific Economic Framework, right? President Biden goes all the way out there. It's a nothing burger. It's nothing. There's no access to the U.S. market. There's no tariff reductions. So you're going to Asia and asking Asian countries who clearly are tied to China. China is the big source of demand. And you're asking them to tie up with the United States without offering any access or tariff benefits. Why? Because it's impossible to get it through Congress. Again, dysfunction at the political level in the United States. And it's always amazed me, as someone who's been thinking about this stuff for a decade or more, how the U.S. assets get valued so highly when the political system is so broken. And I really think that we're in the early stages of people starting to recognize that, and starting to recognize that maybe there's some opportunities elsewhere, which, by the way, are available at a massive discount, a historical discount to U.S. assets, even today.
Yeah, I guess, some of that, has to do, yeah.
No, I'm done.
That's a great point, and because I was breaking up a little bit, so
Okay.
that's a great point, and maybe that has to do with the fact that what happened in the last 10 years, or maybe 15 years, was the fact that the U.S. created the tech giants. So maybe that, even if you take those companies aside, those 5 or 6 companies aside, and they have a big influence on the whole market, but they maybe influence the valuation of all of the ecosystem and everything which is around them. So maybe, and that is maybe nothing to do with that. That's unaffected by the political gridlock. And I wanted to ask you a question. Given that you mentioned the tariffs, you think anything can come out of this discussion about the U.S. removing some of the Trump tariffs on China?
It's something that's getting kicked around in Washington, but in the few areas, very few, where both Democrats and Republicans seem to have some agreement, is in identifying China as the enemy. So I think if they thought it would be beneficial and they could politically move in that direction, I think the Biden White House would have probably already done so, right? Because with the polling and the issue around the economy and inflation is quite negative. So if they thought that they could better improve that by doing something like rolling back the tariffs, I would have thought it already would have happened. I mean, we're getting too close to the midterms. I mean, we're going into summer, right? Less than a month from now will be July 4th. Once July hits, nothing happens July and August. So then you come back in September and you're right into the midterm period where nobody is going to, move, I think, in that direction. So I think it's a talking point, but unlikely.
Yeah, no, it's great. And now you talked about traveling and everything. So you had some interesting comments as well about the ETF conference you went to in Miami. So let us know what you heard.
Sure. It was the Inside ETF, Inside Edge ETF conference, and they put it together with WellStack and 1 or 2 other themes. And so it was, I seemed quite well attended. It was great to be in person again. First conference for me in 2+ years. So I enjoyed that. But what was really interesting was I spoke on a panel regarding thematic investing, right? And, again, goes back to the time to market and the time to invest. If we had had that panel a year ago or 15 months ago, it would have been packed. The room would have been full, right? And people would have come up to us after the panel was over and having questions and asking for your business card, all that stuff. And, you've been to conferences. You know what it's like when you've got a hot topic. Everybody wants to, hear what you have to say. And then there's the not hot topic where nobody really cares. And thematic investing is definitely in that space. So, we had a fairly small attendance at our panel. And I wrote in the musings, I got off the panel, off the stage, and absolutely nobody came up to me. And I was like, wow, was I really that bad? And then I looked at my fellow panelists.
So it's a great time to invest.
And my fellow panelists, there was nobody talking to him either. So it's like, okay, it's not me, it's not him, it's the space, the thematic space. And so, yes, not a time to market thematics, but probably a decent time to think about investing in thematics. And so that was really my takeaway, that the thematic space, and, understandably so, it's been very, very difficult and not a great place. Anything high beta has been really walloped. I mean, our TPW 20 thematic model, I think, has been down 5 months in a row. But when I looked at the data for May, I noticed in April, for example, only like 5 of the 20 thematics outperformed the NASDAQ. In May, 14 of the 20 TPW 20 thematic ETFs outperformed the NASDAQ. So there too, that's one of the great things about having the models. It really keeps us tethered to the markets. And so we can see with the model what's happening in the space. And so 14 of 20 outperforming the NASDAQ suggests to me that, again, much of the selling has been finished. And so we look at ARK as the poster child, right? ARK bottomed 3 or 4 weeks ago at $35. Where is it today? It's at $43, $44. So it's had about a 20% bounce in the last couple of weeks. I think the selling pressure there is pretty much over. If you look, JP Morgan just had some really good stuff I read earlier today on the individual investor, looking at both share investing and call options, the small number of call options, the retail trader. That stuff is completely gone. It's back to the pre-COVID levels. So that whole big YOLO investing and diamond hands and people playing options, all completely gone. It's over. So that tells me we're now in the place where, okay, if the companies have survived, and they have, and the space is growing, as in the climate space and the EV space and the cyber space, et cetera, then maybe there's an area of opportunity. And here's the thing that has struck me, and I've seen very little on it. I think it's an important point. The private sector, the private market space, has not yet caught up to the public market derating, right? The ARK is down 70% from its high. Most thematics are down anywhere from 50 to 70%. Even the climate-related ones are down significantly. I mentioned LIT before. LIT peaked at around $100. Today, it's at $74. It was at $65 a couple weeks ago. So that's the climate stuff. That's the EV stuff is down from 100 to 65. The private market space, the late stage venture space, for example, those guys are dead, because when they come to the IPO market is closed, right? We talked about IPO proceeds down 90% year to date.
Amazing.
90%. Okay, no IPO exit. So you've got to go get money. You have to go for another round. That round is going to be at a 50, 40, 60% discount to your prior round, right, that you did 6 months ago or 9 months ago. So what's the upshot? The upshot is that the public market thematics are going to be protected from new competition for a couple of years, I believe, because of the closing of the IPO market and the down rounds and what's going to happen in the private space. The private space hasn't yet done it. They haven't marked. But unless we have a quick rebound back towards the old highs, which I think in thematics is kind of unlikely in the near term, we don't need to get back to old highs, right? We could double and still not be at old highs in the case of ARK. But my point is that the private sector, there's going to almost be a moat around the public sector thematics, because the private space is going to be basically devoid of activity, I think probably for at least a year or 2 years. And I just note that the Refinitive's VC index, I saw this the other day, I think I mentioned it actually in the Musings, was down 50% year to date, 50%. But companies have not yet come to investors to get new money. and they will. And that's why every tech thing you see now and every crypto thing you see is, cut costs, lay people off, right? Preserve cash, extend the runway. That's all the language in the private space. So I think that's a key point. So your public market thematics have been hammered, are trading at massive discounts. Quick example, ARK peaked at 33 times sales in February of 21. The low was 8 times sales in March of 20. So the COVID low, 8 times sales. ARK today, 6 times sales. So the idea that it's expensive, et cetera, is lazy thinking. And people, there's an opportunity to do some work in this space and take advantage of some of these opportunities, protected from new competition coming into the space, which allows the public existing companies that are in the ETFs to expand the market share as we go into that high nominal growth environment.
And finally, Jay, we have like 4 minutes. You have some important changes to the portfolio. So why don't we go over that?
Sure. The biggest one remember we have 2 models, our global multi-asset, which is our flagship, and then our TPW 20 thematic, which we just spoke of. So let me focus more on the global multi-asset. And the biggest change was our decision to exit crypto. We have mentioned our kind of loss of faith in crypto over the last month or so, last couple of musings. We noted the fact that it didn't provide any diversification, didn't protect against inflation, was trading as basically a levered bet on NASDAQ. So there's absolutely no diversification. And most importantly to me was when NASDAQ did rally over the last week or two, crypto did not. And in fact, we had the Terra stablecoin disaster, where people were just wiped out, not a 10% decline, 20% decline, 100% decline, a wipeout. And so I just have decided that we did not want to continue to have that exposure. We didn't have much. It was a 2% position, but we exited it and we shrunk it. We had a bigger position in the thematics because obviously it's a thematic, but we cut that by 2/3. And the idea being that there's just, it's really probably not a public market vehicle. I think increasingly, as I thought about it more, it's probably more a private market vehicle, in part because it's an early adopter. The early adopters tend to be the big winners. And actually going to the public markets was a way for the private market people to exit their positions in hindsight. And so I think that's the one, all that talk about the private markets being marked down in the thematic space, the one part that may do okay is private market crypto. But public market crypto, I think, has had a serious loss of faith with the Terra coin situation. And so we exited that. We initiated a position in cloud computing. We've been looking to gradually shift move back into technology. We think we've gone quite far in the derating of tech, and particularly things like software and cloud computing and things of this nature, which is only going to grow as we go forward and is growing. And so these things have all been derated dramatically. So we initiated a position in cloud computing. We added to infrastructure, and we added to 5G at our position in 5G technology. And so that was really the big change. We continue to run fully invested in the multi-asset model. We continue to be overweight non-US equity. The other thing about the May performance was the top 10 performers in the global multi-asset. The non-US equity were very heavily populated there. EWJ, EZU, EFV, EUFN, all these, Brazil, EWZ was the best performing market, major market last month in the whole world. We have a very healthy 4% position in EWZ in our multi-asset model. And so non-US, that leadership shift from US tech to non-US cyclical and value, we think we're in the early stages of that. And that's one of the things, again, don't get distracted by all the bad news and the carnage. Markets are telling you what is working, and what is working is non-US equity. So if you're thinking about selling, you should hold the non-US equity. If you're thinking about buying, that's where you should look first. And that's what we're doing.
Okay, that's great, Jay. So fantastic. We covered a lot of ground. So thanks very much once again. And already looking forward to the next session. And have a great week. And we'll speak in 15 days.
Excellent.
Thanks very much. Thanks,
all right,
everyone.
Roberto.
Bye-bye.
Thank you. Bye-bye.
Cheers. Bye.